Hello and welcome to another video by reitspro.com. Like always, we try to give you insightful contents on REITs and InvITs in India. You can connect with us by mailing us or on WhatsApp or Telegram by visiting our website reitspro.com. So today the session is about how good are REITs and InvITs as retirement products. For a more detailed analysis of REITs and InvITs, you can buy these books if you visit our website. Actually, REITspro is the first and only channel which covers REITs and InvITs exclusively for India. So do subscribe to our channel and like the videos. So the first category you could be, if you are watching this video, is that you are looking at FIRE or financial independence retirement, retiring early concept, the FIRE concept. Or I am about to reach the age where I would retire. So in both these cases, you'd like to know whether the REIT product is for you or not. Let me just start with asking you, how would you like to earn 20% per annum on an initial investment of 1 lakh rupees? I think it sounds too good to be true, but then it's possible with REITs. How? Because you need time and patience by your side. And secondly, you need to have correct product understanding. So we'll go on this video step by step. And so first and the foremost thing is that retirement planning with REITs is a globally accepted phenomenon. So you have a 401k tax-free treatment for investment in REITs. Additionally, you can see this graph where a certain percentage of allocation to REITs has been recommended. However, what we will do is we will look at it in the Indian context, because the Indian asset quality is very different and the legislation and taxation aspects are also very different. So the video is about what are the needs of a retired person or a person about to retire or planning for retirement. The second, what are the future possibilities in case of REITs, and how do you fit in everything for yourself? That's what the video is briefly about. So let's get to the first part about what is it that a retired person needs. The first thing that one needs is a stable income, that also with regularity. Second is that the income has to grow to keep up with inflation, because inflation is rising. And the third aspect is also the same way related to inflation. The capital needs to be preserved, both nominal and in real terms. And then unforeseen lump sum expenses have to be met sometimes, where one doesn't know what kind of an expense can come up. So let's evaluate REITs and InvITs on these 4 criteria. So let's take the case of Embassy REIT payouts and Indigrid InvIT payouts. One is a REIT and one is an InvIT. So if you see Embassy, it has been paying out every quarter. So the returns are there every quarter, regular and predictable. So that's the first part. Similarly, if you see Indigrid payouts have been there from 2017 to now, regularly and quarterly. If you'd like to know what the dividend history or the distribution history is, you can visit our website reitspro.com, and there is a section under introduction called historic returns, where we've given you all the links to the InvITs, REITs and InvITs. Additionally, you can also calculate your own returns by downloading a spreadsheet. If you go to our resource section, and there's a free download section where there are spreadsheets also, along with a lot of other downloadable data. So let's see the second part. Now, how does it happen when it comes to the inflation? Does the income keep growing with inflation? Indigrid InvIT does have a rising income over a period of time from 2017 to now, whereas the same thing cannot be said about the total distribution per quarter about Embassy REIT. There is another point regarding what has happened in commercial real estate during the COVID times that we'll come to a little later. So third is capital is preserved. So both real and nominal needs to be preserved. So as we all understand, real estate is a great asset class to hedge us against inflation. That's a normally accepted fact. Additionally, the capital values and rentals increase over time. That's a rule of thumb too. And the third, the rental will increase, which will in fact result in REIT price increase. So we've made several videos before that, so you can have a look at those to understand this concept as well. And the fourth aspect we need to look into is the unforeseen lump sum expenses. So how does that happen in case of REITs? So in case of listed REITs in India, if you recall, if you've been an early investor in REITs and InvITs, earlier the lot size were very huge. So if you see IRB InvIT and Indigrid InvIT, the minimum lot size was more than 5 lakh rupees. Over a period of time, they have reduced to one lot. So which means that you can take out your investments in even single units of one as and when you need it. So the unforeseen lump sum expenses can be met because these are tradable on these stock exchanges. Now let's now come to the second part where we also compare our requirements. So if you are trying to invest for retirement, you would naturally be investing in various instruments. So let's compare and see these 4 points that we've just listed as against debt, equity, and direct real estate. So if you see the first box on the top is about these parameters that we have just discussed. So debt, the positives are it gives you regular and stable return, but the risk is about inflation and high tax, and there could be a fixed tenure. So you may not be able to withdraw money for lump sum needs. So what it does in case of REITs and InvITs is that the first point is that there are higher return alternatives available as far as InvITs are concerned. Secondly, REITs are extremely tax efficient instruments. And if you look at the post-tax returns, even those turn out to be better yields than debt. And the third is that you can easily sell off REITs when you need. They don't have a fixed tenure. The second asset is equity. So you would have equity beating inflation most of the time. And then there'll be low tax on equity, for especially when you hold it for a long period of time. Now, there is a issue of volatility and cash flows. You don't have regular cash flows, and there is a lot of volatility. So REITs, in fact, the regular payouts in REITs, if you look at REITs, they would give out 7 or 8% yields, and about 4 to 5% would be the capital appreciation. So again, 11-12%, which is what equity, the Nifty could give, is given in REITs also, but they smoothen out volatility with regular cash flows. How? Let's look at that a little more. So if you see, I'm just taking a very extreme example in 2020 mid, when prices of everything crashed because of COVID. Then what happened? In that case, this period of time, what really happened was that you had REITs like an Embassy REIT still giving out money. So they were giving out money at that point of time, though it did dip, but there was money flowing in for the investors. So this dip, in fact, this was an extreme case of a dip, but in usual, the variations are smoothened out by the distributions that happen over a period of time for REITs. So that's this part is where you would be getting the payments, which would not have happened in case you just had a fixed an instrument which was not yielding any returns. Now, the third asset we'll compare it to is the real estate direct investment. So the first positive is that the growth would be beating inflation, and stability is there, and there are tax breaks. These are the known positives of real estate direct investment. However, in case of real estate direct investment, you have a lot of management hassles, legal hassles, and vacancy. Now, this is where REITs and InvITs can help, because they are professionally managed firstly, and the share represents each share or each unit of a REIT represents undivided claim on all the assets of the. Say that you have one unit of an Embassy REIT and it's spread out over the NCR 6%, Mumbai 10%, Pune 9%, and Bangalore 75%. One unit of the Embassy REIT stock represents a share in all these properties. Now, why it's important is because when you have direct real estate investment, if the tenant vacates, the whole property is vacant and you are getting no rent at all. So in case a retired person is dependent on such incomes, that's a very big problem. In this case, there's an advantage that it's never completely vacant. So now it looks all very great that REITs and InvITs are really for retirement. But let's just look at it a bit more objectively. So we could say may or may not be. So what are the negatives that you need to look out for to understand that? So why not REITs? The first and the foremost thing is it's an evolving product in India. It's still maturing gradually, although I would say that there a lot of learning has happened because of other markets, and we are pretty much secure as far as REIT and InvIT guidelines are concerned. It seeks to protect the investor quite a lot. Secondly, there is no professional investment management, because there are no ETFs or dedicated mutual funds for REITs and InvITs, though they do have a little bit of uh, holdings in REITs, some mutual funds. Third is the self-analysis would need to be done in case you're holding them and individually, and you need to sort out the good and the bad REITs for now and later also as you invest and hold them. The fourth is that in the rising interest rate scenario, it's a pretty big negative, because if you see that the interest rate is continuously rising, and it has an impact on the loans, the cost of loans, and there are price dips because the market discounts it like a debt. The fifth is the psychological aspect. Now, prices of REITs and InvITs change. There is no assurance of the sale value. Unlike debt, a lot of people get comfort in debt as retirees. There is no assurance of the sale value. So there may be a problem with REITs, holding on to REITs for a very long time, for people who are a bit nervous about the prices of REITs going up and down. Now let's come back to the initial question, earning 20% on initial investment. Why it can happen? Now, as we've seen, commercial real estate rentals grow with time in all probabilities. Why? Because of standard rent clauses, the markets, and the economic activity all going upwards over a period of time. That's the basic assumption and understanding when we do any investments also. The second is that the asset is purchased at rupees 1 lakh will earn more with time, and overall the value of the assets will also increase. However, we are looking at the investment value. So the initial investment will keep earning more, and would mean that in the meantime you're enjoying the returns that are offering currently, and the bonus, even the principal invested, will grow over a time period, and these time periods are a little long. So let's not take a 1 year or 2 year period. This is a longer period, say upwards of 5 to 10 years, that would be taking these results out in future in our current scenario in India. So it's basically about the future estimated demand versus the present or the visible thing. So that's the basic trade-off one will have to do when one thinks of retirement planning with REITs. And what do we suggest? What is it that I suggest here? So what I suggest is have a lot of patience and knowledge. If you are a REIT investor, do look at these books on REITs and InvITs and real estate investment and financial analysis, because there is no substitute to learning about anything, because ultimately it's your money you have to manage, and it's better that you do it in a wiser way. So for that, we do a training and education session to equip you with all the right tools. We don't give any tips. We equip you with the right tools to make you understand the product. So do go to our website and have a look. So the conclusion number one, the first slide, REITs and InvITs for retirement, maybe. Let's sort it out as per individual mindset and needs. That's the first conclusion slide. Second, layer it up. So you could have different asset classes. I never to invest only in one asset class, to spread your risks. So this layering would happen. If you really look at it, debt forms the real base for most people, and that is what most people are comfortable with. But well, it's all dependent on attitude, psychology, and the risk return appetite. That is where the individuality comes in, and there is no fixed rule. And then the timeline that you are in, what age you are in, which stage of life you are in. Are you a fire investor, or you are approaching the retirement age? All that would determine the time you have in hand. And slide number 3, which is the conclusive slide, is that REITs and InvITs are for retirement. Layer it up with correct asset mix, assess your aptitude, and then assess where you are in the timeline. That's what sums up our understanding of how REITs can work as a retirement product. So thank you so much for watching this video, and you can join our discussion group on WhatsApp. Do contact us. Thank you so much.